All right, Mike, it's always great talking to you, man. And with the full report being published and out to the public, when you step back and looked at the full annual data forecast after it was complete, I guess what stood out to you the most about where the self storage industry is in the cycle today?
I mean, really, just that it's like an unusual moment in time where it's a clear buy signal in my standpoint, where you have a lot of recovery slowly taking place. We had such an awesome rental rate growth environment as an industry during COVID, post COVID, and then a really tough couple of years where demand just seemed to fall off a cliff, and it just seems like there's a lot of moments of green shoots in this. Like a lot of the commentary that I had made was revolving around like issues surrounding buyers and sellers coming to terms on where pricing is. And I've started to see people move off of that most recently. And it seems to be like consistent with just like a general concept of like markets are coming back. Equity enthusiasm always seems to have existed here, but now buyers and sellers are slowly starting to kind of agree on where the marketplace is, and that's like a central theme that I've seen play out over the past, call it 30 to 60 days.
No, I think that's so spot on. I agree with that thesis and take where it's a period of pressure, but not structural weakness. And building off your perspective, why is that distinction so important for people in the industry as well as people looking to break in? And importantly, to highlight capital who stay on the sidelines who wants to enter the industry to understand that this is a period of pressure brought on by supply overbuilding more so than a structural weakness.
Well, I think that people that were in the industry were used to just um, let's call it growth rates that were well above inflation.
Yeah.
And so to have like flat to like single digit down growth in some markets feels apocalyptic comparatively. Like it's if you were pro forming in those moments where you're seeing such aggressive growth to win a deal, oftentimes people had to continue to show that kind of growth in their pro forma. And so like fast forward to like reality of what actually happened, you saw negative growth in a lot of markets, and it's like pro forma doesn't work.
Yeah.
Uh, and like expectations are not only off, but you're getting crushed. Even though you might not see like huge spreads in cap rates, you're seeing huge spreads in like actual performance over the past couple of years relative to like what people were actually expecting to see when they bought the property. And so that's tough to stomach
Yeah.
for people that are in the industry. For people that are trying to enter into the industry, what you have is this is what distress looks like in self-storage, which compared to distress in other markets is not that bad. And so like if you're a relative asset allocator, uh, this is still probably one of your most desired asset classes relative to other asset classes that see really like monumental decreases in valuations comparatively. And so um, I guess another way of phrasing it is like the pain that the industry is seeing is still not as bad. It's like they need to put a band-aid on that owie as opposed to surgery.
Yeah. I think that's a great analogy. And you highlighted that we're in a period of distress. How is this cycle of downturn compared to historical ones that you've gone through?
It's it's weird to see real estate going through such a moment of distress with stocks performing so well, and there's and debt markets having a pretty good yield
Mm.
compared to what we've seen over the past several years. And so it's like um, it's interesting to see people saying that they're concerned about a recession when that's exactly what like we've seen our version of that in real estate. And now I'm starting to feel like it's grass shoots in real estate where it's like stocks are still elevated, other assets are still priced pretty aggressively. So I think what's interesting is that right now, relative to asset inflation and other asset classes, like real estate in general seems pretty cheap. And then uh, self-storage, I think, has always performed relatively well to other commercial real estate asset classes. I think what's a little bit different is that uh, to a lot of people, self-storage was considered a niche asset class, but where cap rates are today, I don't think it trades like a niche asset class. I think that there's a lot of institutional enthusiasm for to be invested in this space. And so I think that like one big change is for a lot of people, like core institutional real estate included office.
Mm.
When we meet with lenders and we ask them where they're deploying their capital, a lot of them say industrial, retail, multifamily, and then they kind of are nervous about discussing about their office exposure. They talk about how little office exposure they have. And I think there's other assets that were considered alts that are starting to fill the gaps, including storage.
Yeah, it's definitely became a part of a major food group for capital groups and PE firms. But what do you think that people in the industry, maybe lifelong storage professionals, often misunderstand when they only look at the headline data? Or like, we were just in New York, and some of the takeaways were cautious and telling people to be conservative. How do you think some of those headlines get misrepresented when people don't dig deeper or look historically?
That's a very good question. I don't know. Like I've invested professionally in this asset class for I want to say around 8 years. And that was when I was also investing in other asset classes. And it was like an allocation amongst different portfolios. Whereas
Right.
like the past probably 4 years, this is all I've done exclusively. And so that's like it's hard for me to think about like some guy who started or gal that started in this space in like the 90s, where cap rates were higher. People weren't underwriting to like high 90s, low 80s vacancy. They were mid to low 80s, mid to high 80s, maybe at best if you were being really aggressive in your pro forma. So it's like the industry and expectations have changed a lot too. But I think that right now what I've seen is it's really like MSA specific, city specific on like how you're feeling right now in the industry. I think that there's people that are in historically like undersupplied markets or historical markets that have been like dismissed as not being maybe as productive. Like I sit in Chicago.
Yeah.
A lot of people are used to giving Chicago a hard time from a growth rate story. If you look at how self-storage has performed, multifamily has performed recently, like they're having a darling moment. And so then like the harder part is like, is this just a moment because everyone else has been so oversupplied that storage looks relatively great in a market like Chicago and its suburbs? Or like, is this something that is going to continue on for a long time? And that's tough. Like throughout my real estate career, like the Sun Belt was where you want it to be. And then if you look and see like all the supply waves that have come in without necessarily like as many housing starts compared to like what people were seeing during COVID, it still seems to be like a tough tale to tell. And like it hasn't really shown as much recovery as other parts of the market. And so I think that like not dissimilar from like generalizing office with like ultra high end class A office, like you have something similar going on with self storage where it's like depending on the market you're in, you're feeling very, very different compared to somebody who's like in the Sun Belt versus like low supplied Midwestern, Northeastern market.
No, but you're highlighting something so critical right now, where it's this concept of marrying long-term historical data, market specific as well as national, with the current operating conditions of that given market. And I think you already answered this, but why is that combination so important at this inflection point right now?
Because it's tough to get a sense of like uh, how aggressive do you want to be today as like an acquisitions professional or someone who's trying to build out his portfolio. Like being able to do a look back on historical performance in certain metros is invaluable as we're determining where we want to place our dollars. And
Right.
so like being able to see how web rates have changed, how store rates have changed, and is this a function of like supply in that area, or is it a function of just demand changing? Like it's really helpful to get a quick sense of that if you have good market research behind you. You don't necessarily have to be living and breathing that specific micro market if you have a good data provider that's helping you figure that out.
Gotcha. No, that's a good point, and thank you for flagging that. All right, so if you're an industry professional, operator, investor, lender, what part of that forecast would you tell people to slow down on and really try to internalize as it pertains to market data?
Well, I think the hardest thing to figure out has persisted, especially through especially recently, where existing customer rent increase behavior has changed so much over the past couple of years, and the way that the industry has changed. If you have a bunch of institutional property managers competing in a space versus a bunch of owners that have like one or two assets and that's it, and they're maybe at the store themselves managing their pricing, the web rates that you see versus the effective rates that are being achieved are going to be night and day. And so one thing that I think is tough if you're a lender or if you're new to the space is accepting that. The industry is blessed with having a bunch of REITs that have to share their public information and give you a sense of like how their year over year, quarter over quarter changes are in the rental rates in these markets on like a general level. So it helps create some sort of baseline. But then oftentimes you look at their same web rates and you realize that they're way, way lower than their rents per square foot for what they're achieving in that submarket. And so it's kind of like a central theme of like accepting that in markets that are very institutional, your newest customer is just inherently almost always just going to come in at such a low rate relative to the effective rates at that store. And that's a hard thing to grasp and accept for people, where it's like, yeah, if you look at multifamily, like seeing a 4 to 5% increase is great year over year, but it's not crazy to somebody to see monstrous increases over time of that individual person's rent growth over time in self-storage, just because there's so many teaser rates, discounts, concessions, and in the industry that's really unique, I think, to self-storage in particular.
Yeah, the month-to-month leases were our superpower, and now it's sort of causing some confusion. So building off of that, how should a professional in storage, and you've highlighted this, it can be confusing. How should a professional utilize a longer looking report like the one published, as opposed to a more short-term market update or quarterly outlook? Like, what is the advantage of having a larger time frame of analysis?
I think the biggest benefit is you get a sense of like where people's baselines were and have been as they try to navigate where they can ultimately push rates into the future. What revenues can look like, as housing demand start to shift in a more positive light. And so it's really hard to sometimes have that conviction. And like you see it in some markets where it's like, if you look at where things were in 2018 versus 2020, and then back to 2024, like some markets on their web rates are trading very similar to 2018 compared to where they are in 2024. And so it's like, all right, that's fine. But you also have this period where because 2020, 2021 were just so strong, you have really good effective rates in those stores. And there's concessionary behavior that has changed in how the market used to behave in 2018 versus 2024, 2025. And so it's like knowing that there are many stores that have more seasoned rent rolls that have much stronger effective rates than like what's happened over the past 1 or even 2 years is very meaningful as you think about what you can do as a new entrant in a marketplace, or like a theoretical rent roll and what it could look like over time.
Absolutely. I think you hit the nail on the head where, in storage, you have these mature properties with these like sedimentary layers of long-term renters. And, that might not be a true comp for you developing or picking up a C of O facility, but it is indicative of what a consumer values self-storage to be at. And so when you see markets starting to trend upwards, as you kind of rebound out of the bottom, would it be accurate to say that these more mature stores with a higher achieved rent is still a good indication of where you think the market might stabilize once supply begins to lease up and demand opens up and normalizes?
I think so. But you have to be able to stomach as an investor that the new entrants coming into your market, coming into your store, are not going to look like that. And so it's like it helps serve as like a barometer for like what could happen, right? Upon seasoning of your rent roll. And that's really invaluable information as you think about like, well, how can I compete? How can I grow into this market that I want to grow into? When you're competing against folks that already have stores in this market and they're like, oh, well, I know that I can end up hitting this kind of achieved rate because I have it in my store that's 2 miles away. So like that's your competition. So if you want to compete with people that are also trying to grow, that are already in the space, or maybe I'm trying to buy another store that's close to one of my facilities, I have a different baseline than somebody who's just looking at like 2 years of historical web rates.
Yep. Nah, you hit the nail on the head. This is I think you just have to marry understanding self-storage conceptually on an operational level with understanding these longer term trends and understanding that we're at this very weird crossroads in the industry.
It's fascinating to be a part of. It's fascinating to try to figure out pricing and like our expectations, and it's natural to look at it, to want to have as much data as possible. Having a historical look back is just so helpful for that.
Dude, hit the nail on the head. Mike, thank you so much for your perspective, insights, and being so open to sharing your outlook on this industry right now. I appreciate your time.
Appreciate it too. Thank you so much for the interview.